firstly, we'll be talking about this market update which we updated before market opened. And over here, we did mention that the market will consolidate within a tight range after a gap up, and then the market will the sentiment will be strong, and keeping no trade is a good trade. And which was pretty true, as if you can see Nifty, right? In Nifty, market was market opened and closed at almost the same price, right? And the market consolidated a lot before it gave out a breakout, right? Which didn't last long, but it consolidated a lot, right? And this was purely to take premium decay, right, from the market. And also, and I will also be talking about the short position initially created in Bank Nifty, right? So let's go back to Bank Nifty. And over here, right, you can see that the morning's market moving average, right? Guys, the market moving average, right? The reason I give this a lot of importance is because this is calculated using money flow, and the money flow created in the market will mainly be due to the big players, right? As they put a lot of money into the market to make it move. And using that, I try to figure out what basically where they are like almost neutral, where the bears and the bulls are almost neutral, right? And over here, right, at 10 o'clock, it was at 45,958, right? And because the market is below it, right, that means that market will will resist before going above here, because over here the bears will be and the bulls will almost be at the same level, right? So they will try to consolidate around this price a lot. It will consolidate around this price a lot, which you can see right over here that it consolidated a lot here. If I can make a box, see over here from this price to up to here. In this range, it consolidated a lot, right? Before giving a breakout, and over here at 10 o'clock, this indicator, right? This data point gave a short entry at 10 o'clock, right? At 10 o'clock, guys, the market, right? It was at 45,600, and the market moving average was 950, right? So uh, the market moving average was almost 300 points away from market was 300 points away from market moving average, right? So the chances are it can go back up to here, and if we buy naked put, we'll have to face a lot of loss, right? So what I would have done, right, is because market is moving around here, right, and it's not expiry or anything, right? So I can buy ATM, but if it's expiry, right, then I recommend going in the money. Suppose if it was Nifty, right, I would have gone in the money and bought the put, mainly because of the fact that if it's far in the money, right, you will have to face a lot less premium decay when compared to ATM. But let's go back to Bank Nifty, right? So over here, because it's not near expiry, right? I would have simply bought this put and went 2 or 3 strikes away and sold one. The margin required would be around 15,000, right? And I would have created a position like this, right? So if it starts going down, I will have to face loss, but the loss will be coming from this buy put. The sell put would have been the put that we have sold, right? It would have given me profit. So what I did, right, when while I was in the trade, when it came above the MMA, right, I waited over here, and as it going below the MMA again. Exited this put for about 1,000 rupees profit, and it was at around 1,000 rupees. Oh, around, yeah, 1,000 rupees. So it should have been 230 approximately. I exited around, yeah, around 1,240. At that time, I was over here. It was showing me a loss of a lot, right? Because my buy price was pretty high, so it would have been showing me loss. Net loss would have been about 250, 300 rupees, while market, right? Oh, I would have bought this call. So what I did when I was in the trade, right, is I waited for market to come back to either market moving average or VWAP, and it came back to the market moving average, right? So I waited until it went up and then started coming down. So at here, I when it started coming down, right, I booked this put. I booked it for about 12,000 rupees profit, and then I just waited with this naked. And after it went down, right, it came back down to 45,800, right, which was giving me then uh, I booked the entire trade that then, and I also messaged in the group over here. I can show you over here. As you can see, right, we waited for market to go above the MME, and then once it started coming down, right, from the MME, we removed the hedge and set the stop loss of 500 rupees on of the put option, and then we just waited. And then after some time, right, after some time, the market gave a low of 45,800, a swing low of 45,800. At that time, I said that you should exit out. Like you would have gotten about, I got 1,000 rupees profit in that trade entirely, right? While trading with hedge, right, you'll have some benefits. If you're trading, if you want to sell an option, right, you'll have margin benefits. But if you want to buy an option, right, and if you sell another option, the main profit you will have is that PNL will move a bit slowly, right? So that, sometimes how what happens is you buy a call, right? The market starts moving away from it. You start seeing loss of 1,000 rupees, 2,000 rupees. You cut your losses, right? And then from then market just goes in your favor. But instead, if you also sold a call, right, that time when you went in the initial entry, then what would have happened is you would have seen a loss, but not 2,000 rupees, maybe 900 or 800, 900 rupees loss net overall, right? But then after some time, you will become in profit because the market, your point of view was right, right? So, always when your stop loss is really far away, as in this case it was 270 points away, right? So at those times, what I recommend is trading with hedge and waiting for your market to come to a support or a resistance, and then once it respects that point, right, then cut your hedge position and just stay in the trade for some at a fixed loss, and uh, and you will see it works like magic, right? So yeah, this is about it. And overall, right, what would have happened is if you just bought naked calls and puts, right, if you just traded the future, you would have had to face a loss of 76 rupees in bank nifty, 95 rupees in nifty, uh, then 48 rupees in fin nifty, and you would have had 4 rupees profit in mid cap nifty today. So this is about it, guys. Thanks for watching the video. See you guys tomorrow.